In today's video, I'm going to take a look at the bear market. I'm seeing people trying to trade the bear market with strategies that work better during a bull market. And by that, I mean many traders are looking at sentiment levels, and sentiment is pessimistic. And so they're assuming that because sentiment is pessimistic and the market is oversold, that we're due for a bear market rally. But bear markets are different than bull markets. And so sentiment levels that would generally produce an intermediate cycle low and then a rally in a bull market are not generally extreme enough to ignite a bear market rally in a overall bear market. So I'm going to show you a couple of examples of how bear market can progress, and then we can make a guess as to which one we think we're in right now. But you can see on Friday I warned people about this. People were trying to pick a bottom here at this double bottom, assuming that we were going to get a rally, and I warned people that it's probably a bit premature. First off, this daily cycle still fairly young. I don't generally want to try and pick a bottom until we get into the normal timing band for a bottom. And we're just now breaking through this support zone. So this opens up the possibility for you either a stair-stepping bear market or a crash bear market. And I don't know which one it's going to be. So let me widen the chart a bit. All right, so here is the 2000 bear market, and this is an example of a bear market that's kind of stair-stepping down. So you can see we've got the this intermediate cycle low here. We get our bounce. The cycle left translates, comes down, breaks below this low, and makes a lower low. And then we get another bounce, another leg down, another bounce, another leg down. And generally speaking, once support breaks, you'll get somewhere between a 5 to 10% or so move down, and then that will generate sentiment extreme enough to produce that bear market rally. And then same pattern here. We come down, we break this, and we drop about 5 to 10% below this previous intermediate cycle low. Sentiment gets extreme. And then, we get another bounce, another bear market rally, and on down till we get this final bear market low, and we get a test and a slight undercut here at the bottom, and then that's the end of the bull market. So this is an example of a bear market that's kind of stair-stepping down. Each leg down breaks the previous low and then goes on to generate another 5 to 10% loss before we get the next bear market rally. So basically, once this previous intermediate cycle low support breaks, you don't want to be in a big hurry to try and buy the bottom, because you usually have to go down a little ways, like I said, about 5 to 10%, and then you can generate the sentiment that is extreme enough to give us that bear market rally. So in this chart I showed of the current setup, we haven't really produced that 5 to 10% drop yet, so it's probably a little early to try and pick a bear market bottom. Now let's look at a chart that has crashed, a bear market that has crashed. All right, so the bear market from this fall of 2007 to that bottom in 2009 was an example of a bear market that started out as stair-stepping down, which is kind of what we're doing now. We break this support here, we come down another 5-10%, we get our bear market rally, comes up, tags the 200-day moving average, down another break of support, and it drops a little ways, and we get a very shallow bear market rally, and then we get the crash. And the reason for this crash, of course, was the financial system had about $800 billion in debt that it needed to roll in the fall of 2008, and it couldn't do it. and that triggered the crash event. And so a lot of this bear market came as a break of this support, and then just an all-out panic down to this intermediate cycle low, a bounce, another leg down, and an undercut of this, and this was Bernanke was already starting to do QE, so we get our undercut, and then the bear market is over. So moving on to our current setup, we potentially, I guess you could say, we potentially have the trigger that could produce a crash bear market that would just an all-out panic that loses maybe 1,000 points in a couple of weeks, and then we get a bounce and another leg down. Of course, the Fed's going to panic and reverse course when this happens. Another leg down, potentially that undercuts this March 2020 low, because this is a left translating 4-year cycle. The trigger event is potentially the war in Ukraine if it starts to spread, and seems like a pretty safe bet that the West or the U.S. has initiated or at least given approval for the sabotage of Nord Stream 1. That you got to think that's going to have serious consequences, and if the war intensifies and starts to spread, that could be the trigger that causes this to transform from a stair-stepping type bear market that would stair-step its way down over the next year or so into a final bottom similar to the 2007-2008 bear market, into a crash type event where the bottom just falls out. Everyone panics. There's just no bid. The central banks panic, reverse course. We get a violent bear market rally, and then come back down and get a retest and undercut of that low, and then that would be the end of the bear market. That kind of bear market would probably end a little sooner. I would expect the spring or summer of 2023 would be a timing band, more likely timing band for that kind of a crash bear market, as opposed to a stair-stepping down bear market. I think would probably go out to the middle of 2024 and give us a normal timing band for the 4-year cycle low. Normal would be, since the last low came in March of 2020, 4 years would be the spring of 2024. That would be normal. But if we get a crash type event here, then I think we're looking at something abnormal, and the 4-year cycle would probably shorten just a bit and maybe bottom in the spring or summer, probably more likely in the summer of next year instead of stretching out to 2024. So that is a significant risk. And again, I'm seeing people, continuously trying to pick bottoms in here. And even if we're in a stair-stepping bear market type pattern, I don't think you really want to try and pick a bottom right here, because we haven't really generated that extra 5 to 10% that we should drop below this pivot before we would get our next significant bear market rally. So just be aware, we're not in the same conditions that we are in when we were in the bull market, and the strategies that work during a bull market, the sentiment levels that work during a bull market to put in these intermediate bottoms aren't going to work in a bear market. You're going to need more extreme levels. So just because sentiment is bearish doesn't mean it's bearish enough to generate a rally just yet.